Rob's Child, Nothing I Say is Investment Advice. Welcome back to the series where we review every chapter of Benjamin Graham's The Intelligent Investor. I hope you enjoyed reading Chapter 8. If you haven't, pause the video, read chapter, and then come back and review it with me. I will help you understand anything that you might have trouble understanding. I will try to connect some of the lessons learned in this chapter and all the chapters of this book with what's going on in markets and the economy today, as of June 2024, which is when this is being recorded. And I can also give maybe some insight as to how it relates to the biblical version of Graham's intelligent investing book, Security Analysis. And so we begin. Chapter 8, The Investor and Market Fluctuations. So from the beginning, he spells out one of the main themes of the chapter that he repeats many times throughout the chapter. Basically, it's great to try to take advantage of price fluctuations, but it's dangerous if you get into speculative attitudes and activities. One of Benjamin Graham's biggest goals is to try to make a differentiation between what is speculation and what is investing. What is just like a guess that something might turn out to your favor, and what's like a sound way of saying like this is a smart thing to be buying these, as securities, for these reasons, for this price, etc. And same with selling, that like it's good to sell this at certain prices because it's overvalued, and instead of just trying to follow the crowd and follow whatever's popular. It's kind of funny. Today is actually June 24th, 2024, and Nvidia is down 5% from what looks like it might be even a peak. And so, and I've been bringing up that one stock in many recent videos because I think it's just such a great example of mania speculative value that is undeserved. Companies need to prove how much money they can earn in order for their price to make sense. That's one of the big things. Anyway, to stick to the chapter, I have a quote here. "It is easy for us to tell you not to speculate. The hard thing will be for you to follow this advice." And then another quote, "If you want to speculate, do so with your eyes open, knowing that you will probably lose money in the end. Be sure to limit the amount at risk and to separate it completely from your investment program." So again, sure, speculate. He's saying, please go ahead and speculate, but don't think in your head that you're acting as an investor when you're speculating. That's the big takeaway there. Now, the next part at first glance seems a little confusing, but we'll go through it. So he says that the intelligent investor should be interested in profiting from market swings and using timing, but he doesn't say just because you're interested doesn't mean that you should try to actually do it. You should be interested in it. So, and there's a difference between market swings and using timing, and we'll go through that. And this is like, the timing being that it looks like it's ready to go up or it's ready to go down. And price, and profiting from price, to buy low and sell high, or at the very least don't pay too much for a stock. Now he says, but if most emphasis is on timing, then it is too speculative. And that's what traders do, And if you want to be a trader, don't watch this video. This isn't about trading. This is, this book is how to intelligently invest. Yes, there are ways that people make money trading. They're called professional traders, and some of them do very well. A lot of them don't do very well, but that's irrelevant to what we talk about here. So Yeah, so emphasis on timing. There was a footnote example in the news in 2000, right before the dot-com bubble crack, being extremely bullish, saying, "Oh, stocks are just going to keep going up and up and up," and this happens time and time again. And this was in the newspapers in 1929. Um, you know, there's always going to be speculative views that just see things going up and say, "Yeah, they're just going to keep going up forever," and uh, so anyway, I thought that was a good footnote there. And then he states, some people can make money predicting the market, but you can't predict the market because you are a part of the public, not separate from it. And that's a really good point there. When you're trying to predict the market, you are looking at the same newspapers, the same internet sites, the same things that are being popular and what everyone's saying. You're experiencing it all at the same time as everybody else, and you're a part of that group whether you like it or not. And that's the whole point here, is that that brings up another thing that he talks about in security analysis as well, which is, how do you know that something, if a price has gone very high, how do you know that what you know about the situation hasn't already been priced in at any given time? Any information that you get about a market or a company or bonds or interest rates or anything, how do you know that that information is not already actually priced into the security you're looking at? And he doesn't talk about that here in this chapter, but I wanted to bring it up. So, only some people can do it, but, not very many. Rothschild can, though, because Rothschild, as you probably know if you've been watching the channel, happened to have a crystal ball. Next, we have a 5-star point. The investor doesn't value timing unless it coincides with pricing. So if something seems cheap, then maybe it's a good time to buy it. And if it seems too expensive and you own it, maybe it's a good time to sell some of it. And that's one of the main themes throughout this whole chapter. Now he has a section where he mentions Dow theory trading rules and how it worked great. It worked perfectly until 1938. Now, and I'll add here, when a trading formula becomes popular, it loses its ability to work. And I don't know if he forgot that he said that. He laid it out more clearly in security analysis, talking about that. Back in 1940, nonetheless, only 2 years after this supposed, time period where Dow theory was working pretty well. The point is here is that in 1938, I believe a lot of people learned about Dow theory and how it worked, and all of a sudden, if everybody knows how to do it and everybody knows how it works, then it doesn't work, because you'll have competition trying to chase each other out of the same trade, trying to make the margins thinner and thinner until they disappear altogether. And that's how that works. The more popular any trading formula or technique or method of timing, the more popular it becomes, the less potency it can have, just by the nature of it, just by the fact that it's run by just a bunch of people playing the same game, and that's all it really is at the end of the day. It's a game. Moving on, I said he states, as their acceptance increases, the reliability tends to diminish. So he does say that here. It's more explicit in security analysis. Moving on, we have a quote that says, bull markets had a number of well-defined characteristics in common, such as a historically high price level, high price to earnings ratio, low dividend yields against bond yields, much speculation on margin, and many offerings of new common stock issues of poor quality. So, again, this is his crystal ball saying, this is what tends to happen when, markets are at a peak. But be careful out there, because he basically says, don't rely on timing, at least not by itself. And we get to the conclusion that since you can't predict markets, you really shouldn't wait at any time for a bear market to buy any stocks. In other words, maybe you can get some, but during these kinds of periods, just don't wait forever. But, allow yourself to basically fluctuate within the 25-75 min-max position, where, your bonds minimum are 25, maximum 75, same with stocks, minimum 25%, maximum 75%. And that's how he sees as the most useful way of timing. I mean, he obviously sees the potential profitability being able to time properly. And if you happen to have a crystal ball like me, you can assure yourself that you will become very wealthy. But I digress. We move on to a section on formula plans. And he basically goes through a story about a formula sounding very conservative and working before, and then not working, and then everybody exited. I think it might have been Dow theory, actually. But anyway, a bunch of investors following this particular formula all exited in the mid-50s before, and there was a major stock run that continued through the 50s. And that's like the lesson learned. Like, try to follow a formula, and it might work, and if everybody else is doing it, actually it is more likely to not work. That's the bigger point here. And that makes me think about attitudes towards stocks and bonds today. I think there is a little bit too much, personally, in 2024. I believe the last 25 years of history has taught investors to not believe that stocks are as unsafe as they truly are. With price earnings being above 19 pretty much for a 25-year period, whereas before that you never really got above 19. Everybody, is happy to hold lots and lots of stocks. Especially all of these target date funds that will put you in as much as 100% in stocks, because there's enough of a time horizon. And while it might be true, it's like, makes me wonder if all of this is going to be flipping on its head in the near future. Any formula. Think about what formulas are popular today. What formulas may not actually work that we all believe are going to work. Buy Bitcoin and just hold Bitcoin forever. Maybe it'll work, and maybe it won't. Moving on, notes that new formulas and Dow theory alike, they lost their ability to be successful when they became the most popular. Again, so it's just to emphasize that point. I guess he did talk about that a bit in this chapter. All right, and then I have a 7-point star here. I will note here, cost averaging is more popular now than ever. I should probably do a whole video on this separate target. The separate topic. Yeah, cost averaging is formula investing. And it does make me wonder if it's overdone, and it's time for cost averaging to actually perform very poorly moving into the future. I mean, it seems conservative now. It seems like a great way of, consistently just growing your money over time. I don't know. Considering that inflation is higher than the Fed wants it to be, all while, demographics right now don't really support, growth and more growth and more growth. It's like, what if we end up with, no inflation for the next 20 years, and instead, there's such a fight for yield and any kind of return that, like, it squeezes anything out, and the value of everything kind of just doesn't really go anywhere. Like, It's interesting to think about, at the very least. But anyway, moving on, we have a quote. Here, the moral seems to be that any approach to money making in the stock market, which can be easily described and followed by a lot of people, is by its terms too simple and too easy to last. All right, so earlier in the video, I said that this point was more talked about in security analysis. No, it was, he went over a lot in this chapter. I just want to emphasize the importance of understanding this and trying to relate and really see it today. What is everybody doing, and how might that be wrong? Moving on, we have a section that is titled Market Fluctuations of the Investor's Portfolio. In a nutshell, it's a bunch of words that basically say that stocks go up and down, just get used to it. And he brings up the ins and outs of, he doesn't call it FOMO, but it is FOMO, fear of missing out on it going up, fear of missing out if it goes down, and he goes through the ins and outs of that, basic market psychology stuff. And we have a section on business valuations versus stock market valuations, basically coming to the conclusions that stocks are more liquid than private businesses, so they can fluctuate a lot. And he says usually stocks are too expensive compared to their private value. So when we're looking at the market cap of a company in private industry, people would not normally ever pay as much as the stock market says it's worth, and it has to do with the fact that liquidity gives a premium here. But so moving on, he says there's a paradox going along with this as well. The better the business, the more speculative it becomes as a stock, not counting microcaps. So in other words, the better a business is, the more premium there is in there because of the more perceived safety in it, I would suggest, more than anything else. But the pricing being more speculative than it might actually deserve. And we're certainly seeing this with NVIDIA right now. It's to the point where it's become extremely speculative, even though it's just a solid business. When the price gets too high, it becomes too speculative. It becomes essentially, like I've mentioned in another video, a Ponzi scheme. Essentially, you're just relying on the price of it, but not by the fact that it's a good business, but because other people keep pushing the price higher and higher, and it's dangerous when things like that happen. And then we have he discusses IBM and Xerox basically having too much speculative value, making it vulnerable to major volatility. Again, we're seeing this exact thing literally today in NVIDIA, going down 5%, losing something like $200 billion of market cap. But anyway, I've brought this point up many times in my own videos. Moving on. He says the conservative investor should pay special attention to concentrate on issues selling at tangible asset value no more than a third premium to that price. So you can find that too, tangible asset value, on even Yahoo Finance. I think it's in their statistics button when you're looking at a company's stock. And so that's very conservative. And if you're going to be a conservative investor, realize that when you're buying a stock within that range, you're paying the price for the buildings, the equipment, the stuff that the company owns. If you're paying for the price or less than what that price is, but no more than a third over that price. Yes, it's a business. Yes, it makes money. But a conservative investor takes a look at what he's actually purchasing. That's the point there with a tangible asset value. So below tangible asset value, one should figure out one should figure it out if it's like, well, why is it that cheap? Is it because there's a problem here, or what's going on? And then he says, if there's a premium over price book ratio, like if the price book ratio is greater than 1, basically, it should be seen as an extra fee for essentially having liquidity. Again, with a private business, you would pay for the building, you would pay for the equipment, you'd pay for whatever it is. You wouldn't pay above that price just because it's a business. But the stock market does do that, and he does see that the 1/3 above, so 1.3 book value being okay because it's a stock and it's very liquid. You can trade little pieces of it whenever you want. If it seems too expensive, you get rid of it. If it seems a little cheap, you can buy it, and that's the premium there in the price. Next point, don't chase pop stocks, use valuations tools basically. Again, this is like just common sense stuff. Don't follow the crowd. Don't do what everyone else is doing. Don't chase valuations higher just because they're going higher. That's not intelligent investing. Then he goes on a long example of a great company, super solid earnings in current assets, selling for almost nothing, and then selling for a huge premium, and then dropping again, just emphasizing and illustrating what can happen in the stock market with the price of something, and how the intelligent investor can take advantage of that. If it's clearly a good company, has great earnings, has been paying a dividend, and it's selling for nothing, it makes sense to buy some. It's like, yeah, it's very cheap. And then it goes for a huge premium. It's like, well, this is like, I like the company, but it's not worth that much. So then you sell some of it. That's what the intelligent investor does. That's how he thinks. All right, and then great companies change. So this is another important point to say here, is that you can find a great company, but companies can and do change over time, and you do need to, especially if you're getting into this, buying individual stocks, you do need to be aware of changes. Sometimes it's for the better, sometimes it's for the worse. And he talks about this especially in regard to management, who the new CEO is. Sometimes political things can, if their product is becoming illegal, well, even though it was a great company, if they can't sell anything anymore because of laws, or litigation, whatever, is permanently disabling the business from doing well, that's going to be a problem. But the point here, he says, is that, companies do change, sometimes for the better and usually for the worse. So in his experience, when things do change, if they change, it usually is not a good scenario for the company. I found that to be very, very interesting. Moving on, he says, hold on for dear life. That's not a misspelling. HODL. It's the meme thing for cryptocurrency. Says basically, HODL if you know its true value, trust your judgment, not the market's judgment. So let's say you buy a company, its earnings are steady, it's fine, and the price drops really low. Well, the market's just being dumb right now, and in fact, the intelligent investor might buy more shares at that point. But then he talks about a very hilarious illustration of Mr. Market's offerings, basically talking about how the market offers opportunities to sell if the value seems too high. No, that's not that part of it. You really need to read this section about Mr. Market. He makes Mr. Market seem like an actual, like, legitimate, like, absolute crazy person as to, like, what's going on. He owns a business, basically. Like, say you own a store in a town, and then one day you put up like a for sale sign and you say, I'm selling this business for $500,000. Then the next day, well, it's $600,000. The next day, it's $300,000. Now, who anybody want to buy it? All right, now it's $1 million. Like, and the funny thing is that seems insane, and that's how the market works. That's how the stock market works, and that's how the prices of stocks often work, and that's the whole point of that whole A little story there. Now we're on to the next part. The market offers opportunities to sell if the value seems too high. So, if Mr. Market is offering a higher price than it's worth, sell some to him. And if it seems too low, buy some. Otherwise, just ignore it and enjoy holding the company and receiving the dividends, basically, is what I got out of all that. And we have the section on the summary of the chapter. Is the biggest difference of a speculator versus an investor. A speculator aims to take advantage of movements in prices. So if it goes up and down, trying to take advantage of it by itself. The investor primarily is interested in buying and holding suitable securities at suitable prices, and can enjoy and use the movement of price going up and down, but in general his primary interest is buying, holding suitable securities at suitable prices. That's a very important statement to get out of this chapter. Next point, investors care about the price and take advantage of it when it seems practical. Then we have a quote, on the whole, it may be better for the investor to do his stock buying whenever he has money to put in stocks, except when the general market level is much higher than can be justified by well-established standards of value. And this reminds me very much of today, June of 2024. So right now the general market level is not justified at its price. When the PE ratio of the entire S&P 500 is at 28, Graham would say, do not buy stocks right now. By this quote right here. As much as he also says, okay, 25%, 75%, I'll read this again to emphasize it. On the whole, it may be better for the investor to do his stock buying whenever he has money to put in stocks, except when the general market level is much higher than can be justified by well-established standards of value. Let that sink in. Moving on, mentions that good management serves the stockholders, and how he's frustrated sometimes because management will be like, oh, we can't control the price of what people are paying out there in the market. And he says, well, actually, no. Good managements do produce good prices, and bad managements tend to produce bad prices in the market. If the market, for whatever reasons, believes your company is trash, management, do something about it. Don't just ignore it, is basically what he's saying. And if management is ignoring it and not caring, that might not be a company that you want to own as a stockholder. All right, and then we have a section on fluctuations in bond prices. So we talk about yields and how bonds can go up and down. When yields go up, like value of current bonds go down, yields go down, value of bonds go up. We have a main point here talking about don't count on history repeating, alluding to the fact that you can't, well, it's right here. The quote, it's virtually impossible to make worthwhile predictions about the price movements of stocks, and it is completely impossible to do so for bonds. Now, I think that this phrase needs to be taken with a little bit of a grain of salt. If you happen to have a crystal ball and you're able to see where bond prices are going to be going, you can take advantage of those situations, like when demographics are showing that rates are not going to be holding up in the near future. Reading this chapter really makes me rethink my whole attitude towards bonds and trying to predict interest rates. Not many very successful investors have done that. There are some though, but I won't get into that anymore for the sake of this chapter. don't guess interest rates. Don't guess where they're going to go, is what he's saying. And that's what this is about. We're talking about this book. So when we talk about convertible bonds and preferred shares, can vary in price because of various things. Because they're convertible, their value is tied to the stock price. If the stock price goes way up and you can turn in one bond for 10 of the stocks, well, guess what? Your bond is obviously going to be worth a lot more. So the stock price affects convertibles greatly, but also the credit rating of the bonds. The yield has to go up if the credit rating goes down, and then also the general rates. So when all bond rates are going up, the value of bonds that already exist will go down depending on their duration. The longer out the duration, the more they'll sink or go up depending on where interest rates go, obviously. Pretty self-explanatory. So and then he has a suggestion for corporate bonds, basically be at like a variable rate. I think that's a thing with mortgages, how you can get either a fixed rate or a variable rate. So if interest rates go up, then you have to pay a higher interest rate. If they go down, you pay lower interest rate, and so on. He says, well, maybe corporate bonds should like make an agreement that that's how they work, and like it's tied to their credit rating and what's going on with treasury rates or something like that. And yeah, it's an interesting idea. I'm not sure if that exists for corporate bonds these days. They do exist in terms of like how inflation works with some bonds with TIPS, like treasury inflation protected securities, which is kind of interesting. But anyway, last point, he basically says, by the way, straight preferred shares, so preferred shares that are not convertible or not cumulative, are really only good for institutions because of the tax benefits, and are still essentially trash. And that is Chapter 8, The Investor and Market Fluctuations. I hope you enjoyed this episode, and I look forward to talking to you about Chapter 9 after you read it. Thank you for watching, and see you next time. Rob's Child.